Welcome to Talk Tickers. You're here for the key insights from earnings calls minus the hours of listening. Today, we're unpacking the latest from WEC Energy Group. It's their first quarter 2025 report. Let's dive in and figure out what really matters.
Okay, so right off the bat, WEC reported Q1 earnings of $1.27 per share. A pretty solid start to 2025, wouldn't you say?
Definitely seems that way. And they're sticking with their full year guidance, too.
Yeah, they reaffirmed it. $5.17 to $5.27 per share, assuming, normal weather holds up.
And that long-term growth target. Still 6.5% to 7% annually.
Still the plan. Shows they see a consistent path forward. And good news for dividend investors, too.
Oh, yeah. What was that?
A 6.9% dividend increase. That makes it, I think, 22 years straight they've raised it.
Wow, 22 years. That's quite a streak. Okay, so let's dig into that $1.27 number a bit more. It was up quite a bit from last year.
It was. A $1.30 jump compared to Q1 2024. A lot of that, about $1.28, came from their core utility operations.
And weather was a big piece of that jump.
A huge piece. It actually helped earnings by about $0.18 this quarter, which is quite the contrast to last year.
Right. Q1 24 was unusually warm, wasn't it? Hurt demand.
Exactly. Warmest winter on record in Wisconsin, they said.
Yeah.
So going from that negative impact last year to a positive impact this year made a big difference to the comparison.
Makes sense.
Yeah.
What else drove that utility earnings increase besides the weather swing?
Well, there was a $1.20 boost from what they call rate-based growth.
Earning returns on their infrastructure investments.
Precisely. The Wisconsin rate review that kicked in January 1st was the main factor there, plus about $0 or 4 cents from some tax items and other smaller things.
Okay, but earnings aren't usually a one-way street. What were the offsets?
True. They saw about a $0.14 negative impact from a few things combined. Higher O&M spending, depreciation, amortization, and also some timing differences with fuel costs.
Higher O&M. Did they talk about why that's going up? They expect it to keep rising for the year, right?
They do. They're forecasting an 8 to 10% increase in O&M for the full year 2025.
That seems like a lot. What's behind it?
It's mainly three things. More spending on vegetation management, keeping trees off power lines for reliability costs for new assets coming online, and some effects related to, ironing out the impacts from last year's mild winter.
Gotcha. Okay, moving away from just earnings per share, what about actual electricity usage?
Yeah.
How much power are people using?
Good question. If you adjust for weather, so like weather normalized, retail electric deliveries grew about 7%. That's excluding one big iron ore mine customer.
Only 0.7% seems a bit slow.
Well, the overall number, yeah. But the interesting part is the large commercial and industrial customers. Their usage was up 2.3%. They're actually seeing stronger growth there.
And looking further out.
They expect overall electric sales growth to really pick up starting around 2027. They're talking 4.5% to 5% annually then.
Okay, what about their other business segments, like the transmission company?
Right. The American Transmission Company, ATC, earnings there were up $0 to 2 cents. That was driven by continued capital investment and also a small gain from selling part of a transmission line.
And the infrastructure side, renewables.
Their energy infrastructure segment saw earnings climb by Duro 5s. That was mostly thanks to higher production tax credits, PTCs, from new solar projects coming online.
So tax credits helping the bottom line there.
Definitely. But it wasn't all positive. The corporate and other segment earnings actually dipped by $0 or 3 cents.
Why is that?
Mainly higher interest expense, though some favorable tax timing helped offset that a little.
And you mentioned dilution earlier. A small impact.
Yeah, a $0.02 per share impact from dilution, mostly because they issued new common stock.
How much stock are we talking about?
They issued about $140 million in Q1. The plan for the whole year is $700 to $800 million, and that's part of a much bigger picture, raising $2.7 to $3.2 billion in equity through 2029.
To fund what exactly?
To fund their big capital plan. It helps pay for all those infrastructure projects they have lined up.
Okay, let's shift to that. Management's view on growth. What are they focused on?
The message was pretty clear. Reliability, financial discipline, keeping customers happy. Those are the cornerstones.
And the engine for growth.
That huge $28 billion, 5-year capital plan. They kept stressing these are like low-risk, highly executable projects, all aimed at supporting economic growth in their areas and, of course, keeping the grid reliable.
You mentioned economic growth. Wisconsin seems to be a hotspot, especially that I-94 corridor.
Absolutely. They talked a lot about that stretch between Milwaukee and Chicago. The Microsoft data center complex is a prime example.
Still expecting massive demand from that.
They are. They reaffirmed confidence in that 1.8 gigawatts of new demand forecast just in southeastern Wisconsin over the 5-year plan. That's a ton of power.
And potentially more data centers coming. I think I heard about another one.
Yeah, the Cloverleaf project, planned for north of Milwaukee. Could be at least another gigawatt of demand there.
Whoa. Is that baked into their plans yet?
Not yet. It's not in the current $28 billion capital plan, but they said expect an update in the Q3 earnings call. So something to watch.
Okay. Besides data centers, any other big economic projects they mentioned?
Yes, Eli Lilly is expanding big time, a $3 billion manufacturing facility expansion. And ULINE is also expanding its warehouses significantly, both in that same southeastern Wisconsin area.
So real signs of industrial growth. What about tariffs? Are import costs hitting their plans?
They estimated the impact on that $28 billion plan is around 2-3%. They said they're working on mitigation strategies, like how they contract and trying to find diverse suppliers.
Okay, let's get specific on projects. What's new on the ground?
Well, the Darien Solar Project, that's 225 megawatts. It went into service back in early March.
Good progress there. Any others under construction?
Yep. 2 more big solar ones, Koshkinen, that's 300 megawatts, and Renegade at 100 megawatts. Both are being built now, expected online next year.
And they're buying into more renewables, too.
They are. They got approval to buy 90% of the High Noon Solar and Battery project. That one's slated for completion in 2027.
Batteries are key, too. And they mentioned the IRA, Inflation Reduction Act.
Yeah, they're actively working to safe harbor projects under the IRA, basically locking in those valuable tax credits, especially the PTCs.
Smart move. Any other infrastructure deals?
Their WEC infrastructure subsidiary closed on the Hardin 3 solar project, 250 megawatts back in February. That actually fulfilled its investment plan for the last 5 years.
Okay, switching gears to the regulatory side. What's happening in Wisconsin? Rate cases.
No active general rate cases right now, but they did file something new and interesting. A proposed tariff just for very large customers, or VLCs.
VLC tariff. Tell me more.
It's designed for huge new users. Think 500 megawatts or more of new load. Customers who commit to using dedicated generation resources for like 20 years plus.
So really aimed at those potential data centers, perhaps?
You think so, yeah. It seems tailor-made for that kind of massive long-term load.
What are the terms? How does it work?
Well, the proposal includes a fixed return on equity, 10.48%, and a 57% equity ratio in the capital structure for serving that load, plus other charges. The main goal, they stressed, is to make sure these huge customers don't get subsidized by, regular residential or smaller business customers.
Makes sense. When will we know if it's approved?
They expect a decision from the Wisconsin Public Service Commission by Q2 of next year.
Okay. What about Illinois? There was some regulatory action there too, right, with People's Gas?
There was. The Illinois Commerce Commission lifted the pause on their safety modernization program.
Ah, the pipeline replacement work.
Exactly. The commission directed them to focus specifically on replacing the older, smaller pipes under 36 inches in diameter and set a deadline of January 1st, 2035.
And there's oversight.
Yep. A safety monitor is supposed to be appointed by July this year. They also said they'll provide an updated capital spending forecast for this pipeline work in the fall. It's expected to ramp up significantly. They mention it could be over $500 million per year starting around 2028.
Wow. Okay, that's a lot to unpack. Let's move to the Q&A with analysts. What were they digging into?
Well, the MISO capacity auction results came up. Management felt they were tight, but generally okay for WEC. They basically said, look, we're building capacity to meet this growing demand, including from these big new customers.
They need more generation.
Yes, and they're talking to the commission about needing more natural gas generation, things like combustion turbines and RICE units, specifically to handle that large customer load reliably.
Are they thinking longer term too, beyond just the next few years?
Absolutely. Planning for the 2030-2031 timeframe involves converting some existing plants, Power of the Future and Weston units, to run completely on natural gas. Power of the Future conversion should be done by 2029.
Analysts still focused on Microsoft. Were they worried about that demand forecast?
They asked, but management sounded very confident. They reiterated that 1.8 gigawatt number for southeastern Wisconsin and said they have no concerns about Microsoft's commitment.
And the equity issuance. Any nervousness about that?
Analysts asked about timing. Management said it depends on the stock price and cash needs, pretty standard stuff. But they feel good about hitting that $700, $800 million target for this year.
What about the Inflation Reduction Act? Potential changes?
That came up too. Management stressed that most IRA benefits, the tax credits, get passed through to customers via lower rates. They're aggressively safe harboring projects to lock in 100% PTCs through at least 2029.
What if the IRA gets repealed or changed?
They think the impact on existing projects would be limited, since about 80% of the planned PTC transfers are from projects already running. But they cautioned if the transferability part goes away, it would definitely make future renewables more expensive for customers.
Okay, and that VLC tariff again. More questions on that?
Yeah, mostly around fairness. Management really hammered the point that it was designed with large customers to avoid any cost shift. They painted it as straightforward, fair, and making Wisconsin attractive for data centers.
Interesting. Did anyone ask about residential demand? Why it was up in Q1?
Yes. The main driver was just weather normalizing after that super warm Q1 last year, but they did say underlying customer growth is still positive.
And the other potential big data center, Cloverleaf. What kind of power would that use?
Expected to be a mix, probably gas and renewables to ensure it's firm, reliable power.
What about those tariff cost increases on the capital plan? Where are those hitting hardest?
Mostly on the generation side, solar and batteries. They mentioned trying to onshore more solar production. Battery tariffs are apparently more complex. They said if costs go up significantly, they'd have to talk to regulators about it.
Any talk about potential changes to corporate tax rates?
Briefly, lower rates would generally be good for customers long term, but could slightly reduce WEC's tax shield benefit and cash flow while maybe increasing the utility rate base. Kind of a mixed bag for the company itself.
Were analysts asking about demand from other large customers besides data centers?
Yeah. Seems like many are a bit cautious right now, maybe waiting to see how tariffs shake out. But the underlying economy still looks positive. 10 out of 16 industrial sectors actually grew in Q1.
Any final updates on the Illinois gas situation? Those workshops?
No big news there. A final decision got pushed to next year, but getting the okay to restart the pipe replacement program for the smaller pipes was seen as a positive step forward.
One more on the VLC tariff. Why the higher return? 10.48%.
They justified it by the really long-term nature of the deals, 20, 30 years or more. Provides certainty for both WEC and those large customers over a long horizon.
And that huge Illinois pipe replacement spending, how do they recover those costs?
Not through a tracker or surcharge. It'll be part of future forward-looking rate cases, so the commission gets to review everything for prudency before it goes into rates.
Okay, lots of moving parts there. Now, for the part where we speculate wildly, but plausibly. This is absolutely not financial advice, just some ideas sparked by the call.
All right, let's brainstorm. Outrageous but plausible idea number one. Given all this talk about massive data center demand, 1.8 gigawatts here, maybe another gigawatt there, and WEC creating this special VLC tariff.
Okay, where are you going with this?
What about the companies that make the stuff needed to handle your power? Think advanced grid management software, high-capacity transformers, specialized switchgear. If Wisconsin really becomes this data center hub, those supporting tech companies could see a big boost.
The picks and shovels play for the data center gold rush.
Exactly. The risk, of course, is when this build-out happens, if it happens at the scale projected, and if these specific companies win the contracts. But the demand driver seems pretty clear.
Okay, interesting angle. Here's another one. Again, totally speculative, not advice. Focusing on Illinois this time.
All right.
That accelerated pipeline replacement program for Peoples Gas, they have to replace a lot of older, smaller pipes by 2035, spending maybe $500 million a year soon.
Right, a big undertaking.
So consider this. A speculative long position in companies that provide specialized services for that work, maybe advanced leak detection technology, or specialized construction crews focusing on urban gas line replacement. The mandated work creates a potential surge in demand for these niche players.
Focusing on the service side of the mandated upgrade. The contrarian risk there. Maybe regulatory hiccups slow down the pace, or cost overruns become an issue for the service providers.
Exactly. Plausible, but definitely carries risk. Just food for thought.
Definitely a couple of interesting ways to think beyond just the utility itself based on what we heard.
And that wraps up our deep dive into the WEC Energy Group Q1 2025 earnings call. Hopefully that gives you a much clearer picture of where they stand and where they might be headed.
Yeah, lots going on, especially with that potential data center boom.
So what stood out most to you? That massive capital plan, the data center demand, the regulatory moves, We'd love to hear your thoughts. Join the conversation online.
And just a reminder, everything we discussed today is based on the earnings call information. It's definitely not financial advice.
Absolutely. Thanks for tuning in to Talk Tickers. We'll catch you on the next Deep Dive.